All right, so chapter 21, capital budgeting and cost analysis. So what is that about? Some of the things that we're going to be talking about. Understanding the 5 stages of capital budgeting for a project. Use and evaluate the 2 main discounted flow cash flow, use and evaluate the 2 main discounted flow cash flow methods, which are the net present value method and the internal rate of return method. We're going to be use and evaluate the payback and discounted payback method. We're going to use and evaluate the accrual accounting rate of return method. We're going to identify relevant cash inflows and outflows for capital budgeting decisions and understand issues involved in implementing capital budgeting decisions and evaluating managerial performance, and explain how managers can use capital budgeting to achieve their firm's strategic goals. Okay. So, working in capital budgeting, working closely with accountants, top executives have to figure out how and when to allocate the firm's financial resources among alternative opportunities to create value for the company, because it is hard to know exactly what the future holds and how much projects will ultimately cost. This can be a challenging task. We're going to be explaining the different methods managers use to get the biggest bang for the firm's buck in terms of the projects they undertake. So basically what we're going to be talking about is what goes into the decision to purchase something, a capital item, and how do they go about making that determination, okay? And it's setting up a budget for that item, okay? All right. Capital budgeting is the process of making long-run planning decisions for investments in projects. And much of the accounting income is calculated on a period-by-period basis. And in choosing investments, managers make a decision from among multiple projects, each of which may span several different periods. So if you look in your book, that kind of gives you a visual picture on page 803 of what we're kind of talking about. We have project P, O, M, and N, and you can see some of them are overlapping, right? Because in business, you're not just going to have one project and nothing else going on until it's done, okay? That's just not going to happen, And so we have to, managers are always looking at not just one project, but maybe 2 or 3 or 4. And so that's what we're going to be talking about today. What is the best way and what order to use our money? All right. So we have 2 different intersection dimensions of a cost analysis. We have horizontally across is the project dimension, and vertically is the accounting period dimension. So if you look, we have the purple and the blue, the green, and I guess that's orange, right? So those are straight line, and so that's when you're going straight across, you're just dealing with that project itself. When you're going up and down, you're dealing with that particular period. So like in this one, we have basically mid of 2014 to mid of 2015 that we're actually dealing with all 4 projects at once, right? Okay. Whereas as we're getting more into the future, by the end of 2018, we're even done with them all. Okay. So we have to be able to balance all that kind of stuff. Now, to make capital budgeting decisions, managers must analyze each project by considering all the lifespan's cash flows from its initial investment through its termination. Okay. So what are the 5 stages of capital budgeting? The first one, of course, is going to be identifying the actual project. Identify potential capital investments that agree with the organization's strategy. So what would be an example that Ivy Tech could be to be looking at right now? Or what did they look at recently? Yeah, building this place, okay? So what are some alternatives that they could have been looking at?
Build onto the other building.
Yep, building onto the other building, or maybe a different location. They were given this land, weren't they? Or something like that, I don't know. But basically they could have, improved where they were at. They could have built onto that building, or in this case, build a whole brand new building, right? Okay. Projects that the state might look into. What's happening on 69 down towards Indianapolis? Exactly. Huh?
We're doing the
36th Street.
106th Street overpass exchange.
Yeah, okay.
Whatever, big mess. And they're also going to be increasing number of lanes when they ended this way.
Yeah. So that would be, a project, they had the first project was from 96 or 96th Street down to 465, which would last a few years, and now they are starting a new project, which is the 106th interchange. That's not coming. There's going to be an accident because those lanes are narrow. Have you guys been down those lanes yet?
I know, I'm enjoying
Yeah, they're very narrow. Okay, so would that agree with the organization strategy with Ivy Tech? Building a new building, how could that help Ivy Tech and their strategies? More students want more places to put them, a better learning environment,
Easier access too.
easier access.
Going to town.
Okay, so a lot of different, because we're right off the highway, very easy to get to, whereas before it was in town and kind of hard to find, right?
Well,
Better
two different places.
Better area.
3 different places.
Yeah.
I have it all put up more than it is now.
Yeah. This is a better area than where it was, before. So people would be more inclined to possibly come here, and better equipment now. I mean, they have some nice computer rooms over there now. So, better equipment for the students to learn. So those are some things, and their strategy, of course, is to increase student population. And how do you do that? You provide a better learning environment to the students, which they have. Okay? Then obtain information, gather information from all parts of the value chain to evaluate alternative projects. So that would be, doing the different value or the different locations, what would be best for the school in the long run. And then make predictions, forecast all potential cash flows attributable to the alternative projects. So, if they build on to another building, what could that have done? Whereas here, they have a better building, they have more, things that a student wants here. So what does that mean? That means more students coming in, therefore more money coming in, right? And bottom line is all that's important nowadays. All right, any questions on that? Make decisions by choosing among the alternatives. Determine which investment yields the greatest benefit and least cost to the organization. And in the long run, this might have been a more expensive alternative, couldn't it? But what they got compared to what they would have at the other place would have maybe outweighed that, because here's a brand new building. There we would have to lots of future repairs possibly because it's an older building, right? And then implement the decision, evaluate the performance, and learn, generally separated into 2 phases. So making this decision, implementing. So implementing would be what? Putting together the plans for the building, hiring the architects, hiring the general contractors, getting it going. And then once it's now, they're in the second part of that. They built a building, it's here now. Now they're in the evaluation of the performance and learn What did they, learn from this one, building this one to help possibly other locations around the state? Okay? Any questions on that? And obtain, we have obtained, so in part 5, we have 2 parts of that. Obtain funding and make the investment selected in stage 4, and then track and realize cash flows compared against estimated numbers and revise plans if necessary. Because, here at Ivy Tech, we always have to keep track of our numbers. So, the state's really on top of that. So. All right, any questions? All right, so capital budgeting and working capital. New projects often require additional investments in current assets such as inventories and receivables. Working capital in this chapter refers to the difference between current assets and current liabilities. Any additional investments required for a project would be included in the project's cash flows. So basically what this is working capital is what? The difference between the assets that I have and the liabilities I have. Current, because long term, we don't even look at those. So what kind of working capital do I have to make this project better or make this project go? So like in my eBay business, it would be basically the cash in my eBay account or my PayPal account. That would be my working capital, and so I would be able to use that to buy more stuff, right? Okay. Yeah. All right. Any questions on that? And then investments would be part of the project's cash flows. And what kind of investments do you think went into here at this building? Donations, yeah. Grants,
State funding.
I'm sorry?
State funding.
State funding, possibly some bonds, possibly. So, so they had to organize all that to get the money together to build this building. You notice if you go up and down these things, some of these rooms have, money donated to, blah, 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 So that was a way to build, some of the money for the project. Grants from the state was definitely some, possibly grants or money from local industry here. Because what are they trying to do? They're trying to provide education to their employees to keep the employees, right? So they could have gotten some money there, and then of course state funding, of course, in bonds possible. They might have issued some bonds. So we have 4 capital budgeting methods. The first one is net present value. So if you see NPV in any of the homework assignments or any of the wording from here on out, net present value is what it's referring to. Then we have the internal rate of return, IRR. We have the payback period and the accrual accounting rate of return, AARR. Now, methods 1 and 2, which are the net present value and the IRR, are discounted cash flow methods. Okay, so what are discounted cash flow methods? They measure all expected future cash inflows and outflows of a project discounted back to the present point of time. So what we're going to do is what we think is going to be future amount that we're bringing in and we're taking out, we're going to adjust that to present day value. Because what happens over time? Things go up, right? So we're going to adjust that back to present day value. The key feature of DCF methods is the time value of money, which means that $1 received today is worth more than $1 received in the future. Okay? And the reason is that $1 received today could be invested, say, at 10% per year, so that it grows to $1.10 at the end of the year. So basically what we're doing here is just goes back to like if you look into your retirement funds that you put money into. When you guys retire, what's in your retirement funds? Is it just what you put in? No. okay? So it has grown over time, right? Same concept here. What we have today, is not going to be the same what we have tomorrow, okay? The worth of it is going to be different. All right, the time value of money is the opportunity cost from not having the money today. DCF methods use the required rate of return, which is the minimum acceptable annual rate of return on an investment. So we're going to say, okay, maybe I should get 6, 8, 10% investment. That's my minimum I would require, and so you would use that. The RRR is internally set, usually by upper management, and typically represents the return that an organization could expect to receive elsewhere for an investment of comparable risk. So basically what we're doing is doing a comparison, or say if I chose this other opportunity, what would my money be worth? What kind of rate of return would I get? And I want to use that same for this opportunity. The RRR is also called the discount rate, hurdle rate, cost of capital, or opportunity cost of capital. Okay. All right, the NPV method calculates the expected monetary gain or loss from a project by discounting all expected future cash flows and outflows back to the present point in time using the RRR. Based on financial factors alone, only projects with a 0 or positive NPR are acceptable, and we'll use 3 steps for the NPV method. So some of the things that you're going to be looking at is basically if the NPV number that we project or we figure out is negative, what does that mean? We don't want to do it because we're going to lose money, right? Okay? So if it's positive or 0, those are the good things. So the first thing we're going to do is draw a sketch of the relevant cash inflows and outflows. So if you look at your book, this is actually on page 807. So the first thing you're going to do is going to list the present or the outflows here. So let's go back here. Discount the cash flows using the correct compound interest table from Appendix A and sum them, and make the project decision on the basis of the calculated NPV. Okay? So I wish this was bigger so you guys could see it better. Okay? So we have stretch of relevant cash flows at the end of the year. So if you look at 0, 1, 2, 3, 4, and 5, those are the cash flows that we expect. And so then in the middle, we have discounted present value at 8%. They're saying that the required rate of return is 8%. The initial investment is $684,900. We have a useful life of 5 years. And each year we have annual cash flows of $180,000. So basically we're going to put up $648,900 at the, to get this project going. And every year from that point forward, we're going to make $180,000. Now, if you look in the back of the book, there should be a chart. I apologize, I didn't look at this beforehand. 914, okay? So they're saying that we have an 8% rate of return, and this is a 5-year useful life. So if you look on page 913 or 14, present value of $1, 914, okay? So you want to go 5 periods, and then over to 8%, and that's 0.681. And so that is the 5th period. So each one, for the first period, you're going to use the 0.926. The second is the 0.857. Third is the 0.794, then 0.735, and then 0.681. Okay? Does everybody see where I got those numbers? Okay? So the closer we are to receiving the money, the closer to the value, the full value, we have. Okay? So that's why on the very first line, if you see that, what's the present value factor? That's just 1, right? Because that's today's dollars, and we're discounting back to today's dollars. Okay? So that's the $648,900. That's what we spent. So the first year, the 180, we only have 1 year, so the cash flows are pretty much what we're going to expect, discounting it back to current dollars. So that taking the rate is 166,680. 2 years is at 154,260. Then 142,920, 132,300, and 122,580. Now you take the sum of those cash flows, add them up, and subtract what it costs. So the income minus expenses, just like we normally do in a revenue situation, right? So our future value of all those, the present value of all the income we expect, is the sum of those 4 numbers, and then we subtract the 648. If that result is positive, then this is a good thing. In this case, it is. The difference is 69,840. So basically, in this case, we should purchase the new bus. If the present value of the income was less than what it cost us to purchase that bus, say the bus was $800,000, then we wouldn't want to do that, right? If the bus was $800,000 and we, backed it away from all the income, we wouldn't have made our money back, right? So we wouldn't want to do that. So you take each year of the income, and you use the present value of $1 and discount it back, and take the sum of all the income discounted minus the amount that you paid for it, and then if that number is positive, then it's okay to do. If it's negative, you don't want to do it. Does everybody understand that? Yes, no, maybe?
So if everything under the 649 is more than 649,
then I'm good. Yeah, because everything under the 6489 are income. The 6489 is what it cost me to buy the bus. And then these are the present values of all the income I expect to receive, for this bus while I'm operating this bus over the next 5 years. Take that amount minus what it cost me. If it's positive, then I should buy the bus. That's the first step in the decision. If that was negative, say the bus cost me $800,000, then it would have been a negative NPR or MVV, and I wouldn't even drop the project immediately. Okay? All right, any questions on that? All right, so the internal rate of return method. Well, let's talk about the second one, using the annuity tables. Basically, you can do it 2 different ways. The first one is discounting every single year of the income separately, okay? The second part is using the annuity table. And so basically what you would do is add up all the income, so 180,000 times 5, and then you would use the table number 4 in Appendix A. So that is on page 916. So if you look at that, what you would do is 8% for 5 periods, right? We're still at 8% for 5 periods. Yep, 3.993. So basically what you're doing is taking the amount, taking it times 180 and then times 3.993. You know, what is the future value of that, the payments? And same concept, you would take the difference between the income minus the expenses. If it's positive, then it's a good project. If it's negative, it's a bad project. Okay? Any questions in here? All right, so the IRR method calculates the discount rate at which an investment's present value of all expected cash flows equals the present value of the expected cash outflows. We are looking here for the rate of return that makes NPV 0. A project is accepted only if the IRR equals or exceeds the RRR. Managers or analysts solving capital budgeting problems typically use a calculator or a computer program to provide an internal rate of return. But a more manual trial error approach can be provide the answer. So in the trial and error approach, you use the discount rate and calculate the project's NPV. Find the discount rate for which NPV is 0. If the calculated NPV is greater than 0, use a higher discount rate. If it is lower than 0, use a lower discount rate. And you keep on going until it's actually equals 0. Kind of like the reciprocal method we talked about last week. You keep on going until it got to 0, right? All right, so the IRR method, the table here is in the back of the book, or on page 808. Same information. We purchased the bus for $648,900. We're going to use it 5 years. 180 is my annual income, and my annual discount rate is 12%. So what do? Again, I do the same concept. We can do it either via each year's cash flow separately or through the annuity tables. So the internal rate of return is, we use the table or present values from table number 2. And again, 1 year at 12%. If you look back there, make sure that we understand how that is. Where is my page? Okay. Okay, so 12%, 1 year, 0.893. And then 0.797, 0.712, 0.636, and 0.567. All right, multiply all that out, and what happens? All my present value of my income equals 0. So basically what happens here is you do the same concept as before, but you're going to do a trial and error. So you could start off with 12, you'll maybe start off with 10, until you find one where the present value of the income equals the outgo.
Yes, it's good. Always says situations where it's close.
The only time it can actually hit 0, really, to be honest with you, is if you have that's why, it said earlier that they use computer programs to do this. In our cases, the problems are probably going to be where it hits 0 at one of the problem points. They've made the numbers that way. But in the real world, when you're doing this kind of stuff, you're going to have a computer program to really to do it, to get it accurate. Because, I mean, who says that your income is one? I mean, this is a perfect scenario here.
Right, that's what I was
Mhm.
getting at. If you didn't have a computer program, you didn't, you're gonna get as close as you can.
Yeah, you're going to get as close as you can. That's the only way you can do it, you know. So, and then of course the annuity thing again, you're going to add up all the 180s times 5, take it by the rate that you got from table number 4 for 12%, and of course your income minus your expenses are going to be 0. That's wrong.
Just take, you don't add up all the 180s, you just take 180 times the rate. And
180
the
times the
annuity
rate.
has to be consistent payments every year.
Oh yeah. Okay, yeah. That I was wondering why is that so low? That seemed a little low. So the 180 times the 3.005, that yeah, they have to have the same payments every single year at the same date.
Right.
Yeah, it can't be a different date every single year. So, all right. Questions on that? All right, comparing the MVP or MPV, I want to say MPV or yeah, huh?
You said NPR.
I did. All right, NPV and IRR method. NPV is generally preferred because its use leads to shareholder value maximization. NPV is expressed in dollars, not in percentages. IRR projects cannot be added or averaged to represent the IRR of a combination of projects. The NPV value can always be computed for a project, and that goes back when we were just discussing, under the IRR method, we're not necessarily going to be able to get down to exactly 0. And so the NPV method can be used when the RRR varies over the life of the project. Okay. Now, the IRR is more prone to indicate erroneous decisions. The IRR implicitly assumes that the project cash flows can be reinvested at the project's rate of return. NPV accurately assumes that the project cash flows can only be reinvested at the company's required rate of return. So we might have a different rate of return for different projects, or we might get lucky and say we can invest it at 12% a couple years ago, but now can we invest in 12%? No, right now we can't. Okay, so that's the downfall of IRR. NPV, we can invest at the required rate of return. Still, the IRR method is widely used. And again, to use the IRR method, you really need to have a computer system to do that. Now, payback method. Payback method measures the time it will take to recoup in the form of expected cash flows the net initial investment of a project. Okay, so put it in the way I understand it, the best way is what happens when you refinance a home? What do you have to pay? Yeah, you got to pay interest, but you pay them loan. I mean, refinancing, closing costs. Okay, so basically, your reduction in rate. Say you went from a 5% to a 3%. The payback, to make that, good for you, is how fast, based on the interest rate reduction, do you get your money back for the closing costs? How much interest do you save, and how fast do you get your money back for the closing costs because you saved on the interest? Does that make sense? So that's what the payback really is how fast can you get the money back? Like the NPV and the IRR method, the payback method does not distinguish between the sources of cash flow. Shorter payback period is preferable. So if you ever listen to Dave Ramsey, some of the questions that comes up is, should I refinance my house? Okay? And he'll do a quick calculation based on how much interest they're paying now, what their balance is, and what their new interest rate is. And if they can make that difference based on the savings on the interest rate within 2 years, then, that's good. But if it's going to take you 5 years to recoup your closing costs, then, you might not do it. Okay? So the shorter it takes to recoup your costs, the better off you're going to be. Okay? Organizations choose an acceptable project payback period. Generally, the greater the risk, the shorter the payback period should be. The payback method is easy to understand, and the two weaknesses of the payback method are: it fails to recognize the time value of money. It doesn't consider the cash flows beyond the payback point. So pretty much, once I get to that payback point, I'm done. Okay, I'm evaluating this cost and this problem. Okay, whether I should do it or not. All right, any questions? So, with uniform cash flows, and what are uniform cash flows? Yeah, so in our example with the bus, the 180 is uniform because we continue to get $180 or $180,000 every month or every year. All right, so we're with the uniform cash flows. The payback period is the net initial investment divided by the uniform increase in annual future cash flows. Okay, with non-uniform cash flows, add cash flows period by period until the initial investment is recovered. Count the number of periods included for the payback. So if you're level, it's easy. If you're non-level, it's a little bit more detailed. Okay? It's relatively simple to adjust the payback method to incorporate the time value of money by discounting the expected future cash flows before performing the calculations. Okay? So, let's look at, do we have an example of this in the book?
Page 811.
11. All right, so in the uniform cash flows, basically the hybrid bus Vector is considered buying costs $648,900 and generates a uniform 180. Okay, so basically what we would take is the $648,900 divided by 180 because that's my uniform cash flow every year. So what that means is the answer is 3.6. So that means after 3.6 years, everything after 3.6 years is profit. I've recouped what it cost me to buy that bus, and so then everything after that point is profit. Okay, does everybody understand that concept? Okay, now if you look at the next one, the non-uniform, so we have year 1, initial investment, unrecovered at the end of the year 150, cash savings 50, cumulative cash savings is 50. So basically what here is they're considering purchasing a video conferencing equipment for $150,000. The equipment is expected to provide a total cash savings of $340,000 over the next 5 years due to reduced travel costs and more effective use of associates' time. This cash savings occurred uniformly throughout each year, but are not uniformly across the years. So basically what this chart is telling us is we had the initial investment of $150. And then in the first year, because of that investment, we saved $50. So that knocked off, we recovered $50,000 of the $150. Okay? The next year, we had a cash savings of $55,000. So I'm going to take that $100,000 minus 55. So now I still just need to recover $45,000, which I do in year 3. So after year 3, after $45,001 of that $60,000, I start making a profit for this thing. I got my money back, and then the rest is just pure profit. Okay? Any questions on that? So, an example, like in my eBay business, what we did, I bought this thing of baseball cards, and I bought it for $7. I bought like hundreds of them. I mean, it was a big box, $7. So as soon as I sell, say if I sell each one for $1, my 8th one, I'm making money. That's kind of nice, isn't it? Let's hope I can sell some more, at least, sell 8 of them, right? Which I think I should be able to out of thousands, because it was a big box and I got it for $7. So actually $8 with tax, whatever. But, so after I sell 8, everything after that 8th, that 9th card is pure profit for me. So, all right. Any questions on that? Now, if you look at the next one, you can do the discounted back, same concept as before, where we have the 150 and then discounted present value at $1. For the 50,000, we multiply that by 0.926. And so my discounted savings is 46,300 of that 50,000. Back that out of the 150. And then each year apply the next one, the 0.857 or 57, the 0.794. So if you can look at this one, what happens here is basically it takes a little bit longer to get the payback, right? In that one. All right, any questions on that? Now the payback period of the one above, the chart shows that the payback occurred during the 3rd year. Straight line within the 3rd year reveals the final 45 needed to recover the 150. So basically what you would do is you would take 45 divided by 60, because it only took 45 of the 60, and then add that to 2 years, and that's how they got the 2.75. Same concept as, in the discounted one, 3 full years of money coming in. In the 4th one, we take the 8,000 that we needed, divide it by the present value of $85,000, which is $62,475, plus the full 3 years, and that's how we get a payback of 3.14. Does everybody see that? Yes, no, maybe. Understand how they came up with that? All right. All right, the AAR method divides the average annual accrual accounting income of a project by a measure of the investment in it. That measure of investment in the project can vary company by company, also called the accounting rate of return. The AAR method is similar to the IRR method in that both calculate a rate of return percentage. However, the IRR method is generally regarded as better than the AARR. So, how do we figure this one out? Increase in expected average annual after-tax operating income divided by the net initial investment. Remember that the value used for the denominator can vary, so be sure you understand how the AARR is defined in each individual situation. Okay? So this is on page 814. So if we look at this example, if Vector purchases a new hybrid bus with the 648-900, the increase in the expected average annual after-tax increase cash flows is $174,000. This amount is expected after tax total operating cash inflows of $870,000. 180 for 4 years, 150 for year 5. Okay? So divided by the time horizon of 5 years. Supposedly, so basically what it's saying is for 4 years, I'm going to get 180. And then the 5th year, I'm going to get 150. Take that amount, divide it by 5, and that's how I get the 870. The 174,000. So then it says, suppose that the new bus results in additional depreciation deductions of $120,000 per year, which is $132,000 in annual depreciation for the new bus relative to only $12,000 for the existing bus. So if we didn't get this bus, then we would depreciate $12,000, but because we got this bus, we're depreciating $132,000. So the net change is $120,000 more in expenses. So the increase in expected average annual after-tax income is therefore $54,000. And how did I get that? Took the 174 minus the 120, and that's how you get the 154. I'm sorry, the 54. You divide that by the cost, which is $648. And so my AARR rate is going to be 8.3%. 54,000 divided by 648. It indicates the average rate at which the dollar of investment generates after-tax operating income. So basically, I'm getting an 8% return. Okay. Any questions on that? Okay, some of the advantages and disadvantages. Advantages, firms vary in how they calculate the AARR. So if you go to one firm and they do it one way, that's not guaranteed that's how it's done everywhere, right? Haven't you found that accounting kind of can be subjective? You know, I found that out with the bookkeeping that I'm doing, the way that I would have done things, you know, is different than the opinion of his CPA that does his taxes, you know, and you find that all over the place. So, you know, when you go to one company to next company, you got to be open-minded because their philosophies might be different, right? All right. Easy to understand and uses numbers reported in the financial statements. So this is not made up numbers. These are numbers you actually see, you can tie back to. Okay? Does not track cash flows. So if you notice, what did we not use in any of those calculations for the AARR? Factors, didn't we? Okay? So we just use the actual, the numbers themselves. It ignores the time value of money because we didn't use the factors. We don't have the time value of money issue. And then when different methods lead to different rankings of projects, more weight should be given to the NPV method because the assumptions made by the NPV method are most consistent with making decisions that maximize the company's value. Okay? So if you're doing both ways, you know, give more weight to the NPV method. All right. One of the biggest challenges in capital budgeting, particularly in DCF analysis, is determining which cash flows are relevant in making investment selection. So relevant cash flows are the differences in expected future cash flows as a result of making the investment. The capital investment project typically has 3 categories of cash flows: the initial investment, after-tax cash flows from operations, after-tax cash flows from terminal disposal of an asset, and recovery of working capital. So basically what this is telling us is that There are times when some of the cash flows involved it's immaterial. Okay? So basically you might not look at all the cash flows. Does that make sense? You might not look at them just because they might not make a difference. Like, for example, today I had to deal with the $1,800 double entry into an account. And the big scope of the thing, because this is $1 million company, $1,800 doesn't matter, right? So the smaller the numbers, the least you're going to really care about. So when we're looking at the cash flows, we have 3 buckets that we would put them in. The money that we put up front, the after-tax cash flows from operations. So you have the money that you put up front, that's one bucket. The second bucket will be the money as a result of doing that project that you get, okay? And the third bucket is the money you get after you're done with the use of the project and you sell it, okay? So 3 lives. Think of it when you buy a car. You have what? The cash flows to buy the car, the cash flows to maintain the car while you have the car, and then you get the money when you sell the car. So we're looking at the same concept here. Okay? So, this chart is actually on page 816 in your book. So, 2 methods based on income statement. Let's look at the panel A. We have the operating cash inflows from the investment of the bus, which is $220,000. We have the additional depreciation of $120,000. Okay, so additional income 200,000, 220, additional depreciation of 120. So the overall effect of purchasing this bus has an increase to our operating income of $100,000. Does everybody understand how we got to that number? Okay, so without this bus, we would not have $100,000 on our income statement. Basically what that means. All right, so income taxes, we're going to do a flat 40%, which is $40,000. So our increase in net income in reality after taxes is only $60,000. Okay, so an increase in cash flows from operation. We have method 1 where we just take the cost, which is the 220 minus the taxes, which is $40,000, because we all know depreciation is not really a cash involved thing, right? So the net increase in cash flows is 180. In method 2, we take the net income plus the depreciation and get the same 180. Does everybody see how we did that? Now, in the second item here, item by item method, so here we have the effective operating cash flows. The operating cash inflows from the investment in the bus is still the same at $220,000. The income tax cash outflows at 40%. So how did I get that? I took 120 times 40. Is that how they did that? Yep. So the after-tax cash flows from operations is the 220 minus the 88,000. And so the additional depreciation of 120, if I multiply that by 40%, that's 48,000. So basically, you're going to get to the same result. Cash flows from operation net income taxes is 180. So you have two different ways you can do it. So basically what this is telling us is that as a result, we have 180,000 in cash flows from operations after tax of buying this beautiful house. Okay, questions? All right. So net initial investment, what is included in that? The first one is the initial machine investment, initial working capital investment, and after-tax cash flows from current disposal of old machine. So basically what that is the purchasing of the bus, the initial working capital investment, and then if I have a bus I'm selling, then that would reduce, because I'm bringing in money. Okay? That would be my investment, or reduce my investment. Now, your cash flow from operations, you have the annual after-tax cash flow from operations, excluding the depreciation effect, and then the income tax cash savings from annual depreciation deduction. For economic policy reasons, tax laws specify which depreciation methods and which depreciable lives are permitted. When there is a legal choice, take the depreciation sooner rather than later, because this increases the project's NPV. So tax-wise, we are told what we can depreciate when we can depreciate. So that's why anybody who have done taxes, one of the things in my tax class that they're dealing with right now is markers depreciation, which is not straight line depreciation, okay? You got 179 depreciation, which is basically you can take up to $500,000 in depreciation the year you buy, okay? And then what's left over has to be depreciated 3, 5, 7 years, whatever type of equipment it is, or house or what have you, okay? So like in the example they had $540,000 of equipment. They took 179 of 500,000, and so they had to depreciate $34,000 over the life of the asset. Now you and I, in our books, when we talked about financial accounting, you do what? Either straight line depreciation, double declining, units based, different types. But for tax, basically what happens is that $34,000 in year one, they only can take 14.39% of it. In year two, it increases. In year three, it changes every year what you can take, the percentage of what you can take. If you do it based on percentage. Straight line, you can do straight line. But again, it changes. They have to do the markers, the percentage, and you put the straight line. So tax, that's why sometimes tax depreciation is different than book. So, okay. Now, the third part of the cash flows from an investment is the disposal of the investment. So we talked about the initial, where you have how much did it purchase, and if you sold something as a result of purchasing the new vehicle, how much did you get for the new vehicle, okay? And then we had the cost of operations throughout the year for that. Now we're disposing it. Two components of terminal disposal of the investment. The first one is after-tax cash flows from terminal disposal of the asset, and then after-tax cash flows from recovery of working capital, liquidating receivables and inventory that was needed to support the project. So clearing out anything that is associated with that project. All right. Project management and performance evaluation. We have looked at ways to identify relevant cash flows and techniques to analyze them. Our final stage of capital budgeting is the implementation and control of the project and the evaluation of the performance. All right. So we've talked about deciding what to do, or making a decision, choosing among the issues, or figuring out what kind of projects we're going to do. Then analyzing what those projects entail, making decision, implementing, and now we're in the fifth one, which is evaluating after you make the decision. Implementation and control, management of the investment activity itself, and management control of the project as a whole. A post-investment audit may be done to provide management with feedback about the performance of a project so that management can compare actual results of the costs and benefits expected at the time of the project was selected. So why would a company want to have an audit after everything's done? After they finish and stuff, and they do, they have everything there and they want to audit. Well, to make sure it's right, and also maybe to get some insight in regards to what type, what actually went into the numbers, and it could help them in future projects. Say, okay, we thought this, but in reality, this is what happened. Because we didn't expect this type of expense that was, needed. And so it could help them in the future determining what kind of expenses that they need for a project. Okay. It just evaluate anytime after you do something like this, you buy something, you want to look at it and see, did it make sense, or was it a good thing? Was it a bad thing? Why was it good? Why was it bad? Because, it always helps you in the future. You might never do the same project again, but you will glean something from that project to help you with the project in the future. Okay. All right, evaluating managers and goal congruence issues. A post-investment audit may prevent managers from overstating the expected cash flows from projects and accepting projects they should reject. So another reason is, maybe a manager really wanted this project, and so he played with the numbers and he got it approved because the numbers say it was a good project. But then after the fact, after everything's done, audit proves that in reality, it wasn't a good project. We shouldn't have done it in the first place. Okay? Companies should perform post-investment audits with thought and care, and only after the project outcomes are fully known. So in this case of the bus, when would we do an analysis of the project? At the end of the 5 years. Okay, so when we're doing these type of analysis, it's not the here and now and be done with it within a year. We're looking at the big picture here. There is an inconsistency between using the NPV method as best for capital budgeting decisions and then using a different method to evaluate the performance. Even though NPV is the best for capital budgeting decisions, managers will be tempted to make the decision based on the method on which they will be evaluated. So basically, it's kind of like comparing apples to oranges. If you do analysis of the NPV method, you want to do the audit the same way. Because if you don't, then you're not, Yeah, they won't be a true reflection about what you thought was going to happen and what did actually happen. Okay? All right, a company strategy is the source of its strategic capital budgeting decisions. Managers can use the framework described in this chapter for project evaluation and also make strategic decisions about which customers to invest in. Some firms regard R&D projects as important strategic investments. So again, you can use this type of analysis if you're a business and say you have customers that you want to look and say, yes, they might bring me a lot of business, but does it make sense to continue working with them? And you can use this project to do that. What are some reasons why you might not work with a customer? They've got slow pay. Yeah. Or could be, how much time do they demand of you? If you have a customer that demands a lot of time from you, which takes you away from other customers or takes you away from building your business in another direction, should you just stick with that customer? So you can use it the same way in determining what type of people you want. R&D, strategic investments, who would consider that a big part of their business? Located in downtown Indianapolis. Really. So R&D is probably their biggest expense, or one of them. Because why? What happens after so many years of a drug?
It goes public, or they,
A generic can come on the market, right?
They lose their patent on it, and they, no generic.
Mm-hmm.
If we can work with.
Yeah. Or even that, or just develop a new drug. And so, so they probably have a huge part of this. They do a lot of this. So, all right. Any other questions on capital budgeting? All right. So let's take a good look at that. Let's look at your assignments from last week. How's everyone doing on those assignments from last week? Just started?
I started it Friday.
Uh-huh. Maybe today? Let's look at 14 first. Let's look at your assignment for 14. How about that? We'll do that when we go. Okay, you do have a quiz this week, so make sure you go out on the blackboard and take that quiz. All right, so this week's homework, we have is interested in acquiring a new machine that costs $92,000. It will last 6 years, provide a cost savings of $22,000, salvage value of $10,000. The required rate of return is 12. So you have to compute the project's net present value. And then you have another one here that you need to do. Then we got to do an ARR problem. And payback. Yeah. So you basically have 6 questions to deal with this week. So yeah. All right, So in this week's homework that's due tomorrow night, we have exercise 618 and then questions 1 through 6 below. So the first one, we have Brand Corporation manufactured 2 products out of joint process, the Scout and the Andro. The joint costs incurred are $400,000 for the standard production, generate 70,000 pounds of Scout and 30,000 pounds of Andro. The first question, if there's no additional processing occurred at the split-off point, the amount of joint costs allocated to Scout on physical quantity basis. So how would I approach that problem?
70,000 pounds to the 30,000 pounds, which gives you 100,000 pounds.
Mm-hmm.
Then you take the Scout is 70,000.
Yep.
Okay, so take the 70,000 divided by the 100,000 gives you 7%. 70% of 400,000 is 280,000. So your answer is B.
Okay. So that you got to remember is you got to combine the two first and find the percentage, and then that helps you. You always are dealing with the 400,000. You're allocating different ways of allocating. Basically, what these problems are different ways of allocating the 400,000. Okay. All right. And then 16 is in your book. Does anybody have any questions about 16 in the book? Okay. Any questions about anything? I know we got through this pretty quick today. All right, so homework is due for this chapter tomorrow night. Start working on next week's homework assignments. Look at the quiz and do the quiz by next week. Okay? And yes, shoot me an email and I'll get you a copy. I've got my copy. So I was going to bring it tonight and I forgot it. Yeah, I did. Trust me. All right. So we have that next week. We'll go over any homework assignments that you have questions on. I'll look at the final, make sure that you guys know what type of questions is going to be on the final. We'll review all that kind of stuff and then go from there. Any questions? No? All right.